Today we'll be discussing an important opportunity where fundamentals, macro, price structure, and price behavior all align. This is the taco trade, the oil taco trade, and this is the theory behind it. A simple theory that we will discuss, and of course, nothing said in this video is financial advice. It's for educational purposes only. I hope you can find it helpful, and if you agree or disagree with me, please let me know in the comments. Let's expand on this idea. Maybe we can build a community where we can get those theses and hypotheses and improve them together so that everybody profits, right? So the core hypothesis, when oil enters a high stress regime, elevated for 1 to 7 days, the US has both the incentive and tools to suppress it, means suppress the price, leading to policy-driven pullbacks. And yes, it's the taco trade, and that's for jokes, right? But really, what is moving the market is the people around Trump that inform him and suggest him on ways. This way, it's policy-driven pullbacks. So of course, he has a lot of researchers and smart people that tell him, if we do this won't happen. This is the probability, right? I will just show you a small example of why this theory could be valid. All right, so that's the role of a speculator, right? Outline a theory, see if the market is conforming to it, and test it under some risk-adjusted asymmetric return. So whenever we hit or get near 120, and that's the 4 hours, all right, so that's the 4 hours, we get a sharp pullback right into this zone. What did we call it before? The neutral and zone that can be absorbed by economies. Whenever we get in the macro stress zone, we're seeing a sharp reversal back down, especially right here. After it happened once, it happened here. And it even happened here, right? On 23rd of March. You see that sharp pullback. Why? And why at those levels? Well, those levels are fundamental to how an economy can operate and work. And I will explain a little bit more about what all these levels refer to fundamentally on economies, and that why governments have the incentive to actually pull their price below them. So ideally, you want to be below any of that range, right? Here it can be absorbed. Here it becomes harder to absorb. You build pressure. Here it's a macro stress zone, and here is complete recession fear, stagnation crisis trigger. Okay, that's why we don't want to get up there. And those levels were drawn out way before. So we had drawn them out, I did, on the first leg up move of oil to see how, at what levels it will become dangerous for economies and how I should trade risk assets as a result. But as I'm tracking oil to track risk assets, I found a pattern that I couldn't just ignore. And I really want to trade oil now. I mean, think about it. And I'm not trying to convince you, this is educational purposes only, so please do some further research after, right? But what did Trump do to equities every time they dropped 10%? All right, this has been a core thing playing out during his presidency, right? Every time it went 10%, there was some bullish thing said by Trump on some of his social medias that put up the stock market. And then, also when rates were actually 10-year treasury rates, if they get above a certain level, he always chickens out. Hence, the term came out, taco. Trump always chicken out. From that, from the yields, from equities, and now that's not his main aim anymore. He's letting sometimes yields run up, he's letting equities fall down, but they did rise up, surprisingly good. But now he's more concerned about oil. That's why he's doing the taco move on oil. His administration and researchers and those guys who help him in the administration. So we're seeing fundamentally, which we will explain later, aligns with structure and price behavior. Price behavior, those abrupt moves are not natural in a way. So who would really sell oil that fast on days when Trump chickens out? All right, Taco. Huge funds, right? Insiders, people who are familiar with the matter, who already big traders who actually saw this coming and saw this pattern play out before, right? You can see that oil grinds up slowly. But then when it grinds up to a level that economies cannot handle, a level where it becomes very dangerous for economies to operate and not get them into some form of crisis like a recession, or if you also get high inflation and a recession, you get stagflation, which is something you absolutely want to avoid, especially if you want to be re-elected on the next, votes. So of course you don't want to form some kind of crisis. Even everybody will have to do what they have to do. And the administration, the Republican administration, is not going to let the Democrats win, right? So the whole administration has an incentive to back Trump and to guide him on not getting the economy into dangerous territory. Also, who would really want their country to be weak and in a recession when you're about to enter a war that could lead to a world war? So when a country needs to join a war, they need to be strong to be able to win it and stay long enough with it. They don't want an economy that drags them down. You don't want people complaining and civil wars and protests and people not going to the army and hating the government, because you already get a lot of negativity and negative sentiment uh, in the society of the country when it enters a war. We've seen that in Russia, right? The economies was booming. They entered the war. They were strong. After 2 years, they started to be weak, and their economy now is slowing down, and people are unhappy, and people are actually flying outside of Russia, and now people are refusing to go to the army. Slowly, they're having inflation problems now, and the economy is expected to slow. But of course, the Iran conflict has helped them because now they're selling their oil. That is not sanctioned anymore. Why would Trump unsanction oil of a sanctioned country, of an enemy country? They even unsanctioned Iranian oil. There's a theory that speculators speculate on the future, so we price in the future. But if you dive deeper into that theory, there's also a hidden clause where speculators help determine how the future plays out. So if we expect higher prices, we're going to price oil higher, right? That would lead Trump to make some decisions, political driven or not, to suppress the price of oil, not to hurt their economy. So he would put some narrative or some piece of headline to push price of oil down. But that narrative or headline does something in the real world as well, right? It affects peace talks, negotiations, it affects relationships between enemy and non-enemy countries. And from what we're seeing, there's usually two types of regimes. Okay, there's many, but there's also a set of group of regimes that works. Currently, we're in a narrative-driven regime for oil. Before, it has been also for equities. I would suggest that equities are still in that narrative as well, right? There's usually a structural narrative regime, and there's a structural regime and narrative regime. Structural means oil would react to attacks on oil refineries or pipelines or actual trade numbers, right? Or how many ships are passing Strait of Hormuz, or supply, demand, distribution, all this stuff, manufacturing or extraction. This is what usually moves the price of oil. Right now, every time there's ceasefire plans or ceasefire talks, or saying that, oh, Iran will open the Strait of Hormuz, you're getting price of oil just abruptly move down in 4 hours after the headline. What does that signal? That signals oil is currently in a narrative-driven regime. So this is the whole theory and why I think fundamentally it aligns structurally and price behavior. Let us now discuss. And then I'll tell you where I think oil would get rejected from and where Trump could tackle again with some policy driven, what's the trigger and what's the price level at which we could actually reverse back down. So right now we're going down. I think I'm not sure how, my concern is not how low we go. The concern is on where we get rejected. That's the trade idea. So usually if you go to the 3-day chart, right, you have different levels of oil at which it determines the current macro regime of the global economy in a way. So here we're just going to simplify to the US because the US markets has the biggest moving force on assets, such as especially global assets such as oil, right? So let's focus our attention there. But this applies to many economies. So let's say an economy has oil prices at those levels. If the economy is strong, then it can be absorbed and you wouldn't feel the effects of that rise in price. So you would have a 10 to 20% risk of anything going bad. But if you're at that level, from 85 to 100, this is a pressure building zone. So you don't ideally want oil to go there. It's bad for economies, and over time it can make problems with 35 versus 50% chance around there, right? But if you go to the macro stress zone, then you have 60-80% chance of something bad happening, and that's not immediate. So price has to actually go there and remain there, and that end probability probably combines how the economy is doing and what's the average price of oil over the determined time frame, right? So the intersection of that, or negative intersection of that, would mean a recession or something like that, right? So you just ideally, in general, you don't want oil to be above $100 a barrel. But if you go over 120, that's extreme danger zone. You can see in history, we have only been there during the 2008 financial crisis, and that just abruptly went down. So when we reached there, we just went down quickly. And every time we wick there, we do go down. Governments and make policy-driven pullbacks. That's the idea. Therefore, I believe it is not idiotic, at least, to think that if oil touches and reaches the crisis stagflation trigger zone, we would see Trump chicken out and tackle to push oil price down. How low? Don't know. Are we able to break above that zone? Possibly. Historically, hasn't been done, right? But very possibly, we enter a new regime, world regime, global regime of heightened oil prices for a long time and Mad Max on mode, right? I don't know. That's not going to be Mad Max. I think Mad Max will be like $1,000 a barrel or something like that. But you get the idea. People will start thinking about consuming oil and energy a little bit more. But of course, every trade has risk and reward. This is for speculation purposes only. Historically speaking, we had not been able to sustain and move above 120 for a long period of time. Historically and recently, every time we went and touched that zone or got near it, we quickly got rejected from there with an abrupt move down. And historically, currently, that move has been coincided with the Trump administration doing something about it, making a policy-driven pullback that is megaphoned by Trump's social media. So the trade level, the price level, you get that zone, that circle around between the macro stress zone and crisis zone. The trigger, Trump tweets out something, truths out something that might make the markets react in a narrative-driven way. But of course, the market can always shift to structural driven regime anytime. We should be aware of that. So risk has to be maintained, and always think as a speculator in terms of your capital risk and how long, capital management rather than profit making. That's how I do it. I hope this video has helped you to do something or think of a new trade idea. If you enjoyed it, please do like. It helps the channel a lot. Comment some of your thoughts about this theory, where it goes wrong, where it goes right. Do you agree? Do you not? And if you try it out, do please reach out to me and tell me how it went, because I'm definitely trying it out. And not financial advice. I'll see you out in the next time.